All right, we got a little time here into the bell. Let's talk some fixed income and get ready for a week ahead that has a lot of economic data in front of us. Cooper Howard joins us, Director and Fixed Income Strategist at Schwab's Center for Financial Research. Cooper, what's the most important print this week? Because we got a lot coming.
You know, we do have a lot coming, and I will look forward to Friday. I think that that's going to be the big one with the non-farm payroll report coming out. Now, the market is expecting that we're going to see a gain of 160,000 jobs. That's a little bit weaker than we saw last month, where we gained 227,000 jobs. But if you look at the unemployment rate, that's supposed to hold steady at about 4.2%. The other thing that I'm going to be watching this week, Oliver, is what happens with the JOLTS report. So last month, we saw the quits rate was up a little bit, but the hiring rate was down a little bit. So little bit of a mixed bag, because you would expect that if you would see the quits rate move up a little bit, that should be a signal or a suggestion maybe that individuals are a little bit more comfortable with the labor market and they're comfortable quitting their jobs and going out and trying to find something else. So I think in terms of what to watch this week, it's going to be the labor market reports.
Okay, so quit rates. Interesting, because that has kind of been a little bit of a leading indicator, right?
Yeah, I do think that that's interesting. Also, if you look at the ratio between the number of jobs openings, to the number of people who are unemployed, that's about 1. So that has come down quite a bit. So what I think is important about that is that it shows that although the labor market's not falling off a cliff, it is softening a little bit. So that's going to be important in terms of what the Fed is going to do. And looking back to the most recent dots plot, there was a lot of variability, a lot of dispersion about what the Fed was projecting for where they're going to end up in 2025. So that labor market mandate, I think that's going to come into especially important play for the fixed income markets this week, Oliver.
Okay. Generally, you guys are thinking yields could keep creeping higher, right?
You know, we have shifted a little bit of our guidance following the election. So for listeners who don't regularly follow our content, that is something that we made a shift of. We are suggesting a benchmark and below duration because we did see a catalyst for yields potentially moving higher. I think a lot of that move higher has been somewhat discounted so far, Oliver. You've already seen the 10-year Treasury move up 50 basis points since the lows at the beginning of December. But I do expect there might be potentially some further upside in longer-term yields from here. We do expect that the Fed's going to cut interest rates, so I wouldn't be too shocked if we see a little bit of a yield curve steepening, this year. So what we've been suggesting to our clients is it takes take a little bit more of a prudent or cautious approach on duration bets. We still think it's relatively appropriate for a benchmark or below duration, but as we continue to see yields move up, that presents more opportunities out there.
Okay. If we do see the Fed surprise in any way, which way do you think that likely is to be? I've been hearing most of our guests say 2 to 3 cuts this year. Do you guys think they may be pinned a little bit more? Maybe can only do 1 or 2?
You know, in my opinion, I think that the surprise would be to fewer rate cuts. And the reason being is that, yeah, the labor market is softening a little bit, but it's still holding up okay. The economy is running at about 3% GDP. So that's by no means a falling off of a cliff scenario or a hard landing scenario. But with inflation not going down to their 2% target as quickly as expected, I think the case for fewer rate cuts is stronger than the case for more rate cuts. I also think that was displayed in the meeting or in the dots plots from 2025 during the last release. There was actually one official who projected no rate cuts. Another official projected 125 basis points of rate cuts. So I would not be surprised if we see a little bit more volatility into this year.
All right. Like it. Good setup for us this week and a good bond conversation to kick off 2025. Thanks, Cooper.
Thanks, Oliver.